Good morning. It's Monday, the 30th of September, and this is Govindraj Ethiraj, headquartered and broadcasting as well as streaming from Mumbai, India's financial capital. Well, this is the end of the second quarter of the financial year, the third quarter of the calendar year, and here we are, halfway or three quarters of the way, depending on which part of the world you are in. So, hope you've had a good last quarter. The take. JRD Tata was known for his blue notes, summaries and observations of Air India flights he took, the airline he founded in 1932. In 1951, he pointed out in one such blue note that on one aircraft VT-DAR en route to Europe and back, some of the seats reclined much more than the others. As a result, he suggested that all our seats, that's Air India seats, be adjusted for a maximum reclining angle, except of course the rearmost seats limited by bulkheads. In another note, he said the tea served on board from Geneva is, without exaggeration, indistinguishable in color from coffee. I do not know whether the black color of the tea is due to the quality of tea leaves used or due to excessive brewing. I suggest that the station manager at Geneva be asked to look into the matter. The next few decades saw a deterioration in Air India's quality offering service that is history and book-worthy, in the section on a spectacular decline and fall of businesses. If you were to put a price on it, Air India ran accumulated losses of over 70,000 crore rupees and debt of over 60,000 crore rupees at the time the airline was going back into the Tata's hands in January 2022, who, by the way, were forced to sell it to the government in 1953, though JRD Tata did stay on for a little longer. A spate of viral videos and several social media outpourings once again about the cringeworthy condition of Air India's long-haul flights reminded me that it is quite possible that JRD Tata's advice has still not been heeded in general and specific. To be fair, Air India is furiously overhauling, or says it is, its aircraft and people, though it evidently has challenges on both. For instance, accounts of counter encounters by passengers suggest that staff are often unhelpful or barely helpful and would rather wish away a problem and the person rather than attack it. But this could be happening with other airlines too, and there is no fair way to launch comparisons. But things become a little clearer and sharper when it comes to the quality of interiors and in-flight service. And here is where I think JRD Tata would have surely stepped in. I watched, as some of you did, the plight of a passenger who paid over $6,000 or close to 5 lakh rupees for a one-way Delhi-Chicago first-class ticket and then posted a video of the obviously abysmal condition of the seats and aircraft. Add to it, the in-flight entertainment did not work on that 15-plus hour flight, nor was there Wi-Fi. The passenger was apparently given a full refund. He was lucky. Many other passengers who've complained or borne their misery with silent grace have not sought or got refunds. Another passenger said she had to bear with a broken tray, reading lights continuously blinking, and of course no entertainment system on a 16-hour flight from Mumbai to New York. All this while Air India is charging the highest fare for this sector and charging for seats too, she said. Now, I had a similar experience, though not first class, on a JFK Delhi flight on Air India 2 years ago, where almost nothing worked and the seats groaned and protested, and the cabin crew seemed to be mostly focusing their energies and smiles on some VIP or such in the front. Now, it is clear that some of these aircraft, particularly long-haul, have been problem children for at least 2 years for the Tatas, and I am assuming the previous management did not care. Now, it would take a staggering amount of indifference and corporate blindness for the top brass not to have noted the state of the aircraft on their prime routes in their reviews or travels, if they indeed chose to fly in their own airline as JRD Tata did. So the question is now, why did they not, or why are they not doing anything about it? The answers could be many. The most obvious is that the demand on these sectors is so high that the airline would rather sell the seat at the highest price they're able to command. And of course, a few passengers will turn out to be trigger-happy Instagrammers, but that's the price you can decide to absorb, I reckon. Worst case, you refund. To the rest, you send a most apologetic Twitter message, perhaps even with a few sad and regretful emojis thrown in. Now, this is where Air India has been quite evidently dishonest. I don't have to scour social media because I have experienced it firsthand and heard from others too. The airline could be clearly warning passengers on these sectors that their seats are a disaster and there is no in-flight entertainment system worthy of speaking about or listening, and service is a hit and miss. Of course, no airline will willingly do this, but what it can do is to offer at lower price points, particularly the aircraft that are old, creaking, and provide a seating comfort that's similar to a cramped bullock cart on an unpaved road. Many airlines, including Emirates, are offering unbundled business class fares where you pay less and get less. For instance, no lounge access, no chauffeur pickups, and adjusted miles. Air India could do that too for these aircraft. Now, this is a software fix, not a hardware fix, which could take time. Perhaps if Air India's top brass took a leaf out of JRD Tata and traveled in their own aircraft for 15 hours incognito, they may change their minds. And that brings us to the top stories and themes for the day. The stock markets take a breather, but poised to rise again. India leads global initial public offer or IPO mania. Non-resident Indians can rejoice. Indian rice is headed back into global markets. Why India needs more container ships and what can be done. And India's China conundrum and how import duties could be affecting government-owned companies as well.
This is the Core Report with Govindraj Ethiraj.
The markets are poised for fresh recoveries. So the stock markets took a breather once again on Friday, as they now so often do after running up and away, setting record highs every day of the week last week. On Friday, the BSE Sensex was down about 264 points at 85,571 after hitting a, not surprisingly, record high of 85,978 during intraday trade, that's on Friday. The Nifty 50 also hit an all-time high of 26,277 before ending Friday's session down 37 points at 26,178. For the week as a whole, the indices were up between 1.5% to 1.2%, and this also marked, importantly, their third straight week of gains. So the markets have been rising every day since the Wednesday week before last, when the US Federal Reserve cut interest rates by 50 basis points, which in turn is seemingly and predictably pushing up foreign investor flows into markets like India. IT services companies' fortunes are looking up. We spoke last week about Accenture's numbers surprising Wall Street for the latest quarter and the artificial intelligence business bump up. So will the Indian IT majors come in with similar surprises? Well, let's see. Reuters also reported that metal stocks gained more than 7% in their biggest weekly rise since December 2022, outperforming other major indices. Now, all this is thanks to strong metal prices on hopes that new Chinese stimulus measures will boost its economy and global demand and lead to a decline in the dumping of steel products in countries like India. Though, as per latest reports, Indian steelmakers still want duties on Chinese steel imports hiked. And more on those Chinese imports shortly. The IPO mania continues. India is leading the world in the number of IPOs raising funds, a phenomenon which is frankly and mildly worrying since it does suggest some overheating. Remember that more mega IPOs are expected, including from some of the tech companies as well as Hyundai's India arm, possibly with the largest IPO ever after Life Insurance Corporation in May 2022. A Business Standard report quoting Global Data, a London-based data analytics firm, says that 822 IPOs aim to raise about $65 billion in the first 8 months of the current year. That's calendar year till August. Of this, Asia Pacific recorded the largest number, totaling about 575, amounting to about $24 billion. India was at 227 transactions, totaling about $12.2 billion. So 227 transactions from about 822 transactions globally. So there is a global wave of fundraising happening and investing, obviously, with many markets, including the United States, hitting all-time highs, which obviously leads to funds flowing into IPOs and companies trying to make the best, or rather make hay while the sun shines. A report in the Business Standard says over 20% of companies listed on the BSE Mid-Cap and Small-Cap Index have seen a decline in promoter holdings for 5 consecutive quarters. The report sources data from DSP Mutual Fund. Further analysis by Business Standard using capital line data shows lower profit growth for companies in which promoter dilution has taken place. Now, while there is a global wave of fundraising, as I said, and promoter dilution happening, all of this obviously makes it a little more fragile, as it usually does at new peaks in the secondary market and IPO issuances. Global data says that the sectors leading the way in IPO activity globally so far are technology and communications, followed by financial services, then construction, and then pharmaceuticals and healthcare. NRIs can rejoice, non-basmati rice is coming your way. The Indian government has allowed exports of non-basmati white rice to resume as inventories have increased and farmers are staring at a bumper crop harvest in a few weeks. Earlier this month, the government also removed a floor price for basmati rice exports. Remember, exporters were complaining, including on the core report, about their inability to take on competition, including from countries like Pakistan in the global basmati rice market. All of these moves will likely or should improve farm incomes or incomes for farmers as well. These export bans were in force since last year. The other plus of India's removing of export bans is obviously that international prices will be lower. And of course, India's thriving non-resident Indian community, or NRIs, would be most grateful going by their reactions when the bans were first imposed. The government did set a floor price for non-basmati white rice exports at $490 per ton and also cut the export tax on white rice to zero. On Friday, India also reduced the export duty on parboiled rice to 10% from 20% previously, according to Reuters. Before we continue, a short break. If you are a small business, here is a useful announcement. Did you know that Google Maps, Google Search, and GPay, among others, can help you reach more customers and much faster? The Core Report invites you to hear top Google leaders tell you how to leverage new features from the Google tech stack. Join us at the Google India Small and Medium Business Summit at the Leela Ambience, Gurgaon on the 4th of October 2024. Do go to the link in the description and register now. And yes, it's free to join. And now, back to the show. India's container shipping industry challenges. 2 weeks ago, the government said the state-owned Shipping Corporation of India would soon start operating a large container ship and buy 5 additional second-hand container vessels to counter the logistical challenges caused by the Red Sea crisis and overall prices shooting up. Ports, Shipping and Waterways Secretary to the Government of India told media persons that one major concern raised was the refusal of foreign shipping lines to allocate slots for Indian goods amidst a surge in freight rates and global demand and the negative impact on trade due to the absence of an Indian shipping line. Now, the solution appears to be to own more Indian-owned shipping lines, particularly those that carry containers. The Indian Express quoted exporters saying Asia to North Europe rates had more than doubled to about $4,000 per 40-foot container. A TU, the term we shall encounter shortly, is a 20-foot container and more on that. The Global Trade Research Initiative, whose founder Rajesh Srivastava appears frequently on the Core Report, has recommended that India should boost domestic container production, enhance the role of local shipping companies, promote use of domestic containers, and strengthen local shipping firms. India produces between 10 and 30,000 containers annually, while China, the global leader, produces about 2.5 to 3 million containers per year. So that leaves India with less than 1% of the global market share, making it vulnerable to disruptions. Moreover, about 90 to 95% of India's total cargo is carried by foreign lines such as Maersk, MSC, and COSCO. India's shipping companies, that is led by the Shipping Corporation of India, handle only about 5 to 10% of trade by volume, according to the GTRI. I reached out to Aniket Dani, director at Crisil Limited, who also tracks this, and I began by asking him to define the scope of the larger problem of shipping containers and, of course, what could be done.
So, if you look at the overall container shipping capacity globally, the fleet size is about 5,800 ships and it can carry about 2.58 million TEUs. But if you look at India, India has just 1,500 ships, out of which only 5% is containers, which means about 70 to 75 ships, container vessels is what we have. So what this translates into is about 90-95% of India's cargo is transported on foreign shipping lines. And what we have seen in terms of demand supply is that before the Red Sea crisis, there was a oversupply of containers and container ships. But suddenly after the Red Sea crisis, it has converted into a shortage, which has led to increase in freight rates. So this is the scenario that we are in currently.
Okay, and so why has there been a sudden crisis? I mean, of course, we all know that ships are taking longer to go around the Cape of Good Hope and so on. But why is this? I mean, why is there a supply shortage?
It is actually not supply shortage, but the capacity has remained constant. So number of vessels and the TEUs that they can carry. But if you look at the route that is being used, so if we transport any merchandise, exports are done from east to the west, which is to Europe or US. Earlier through Suez Canal, it was taking about 20 to 22 days. Now it is taking about 35 to 37 days, which means an increase in number of days, about 10 to 12 days. This, I think, has brought down the overall capacity within the system. Right, so now we have a shortage of about 5 to 6%.
That's the global shortage, or
the global shortage? Yeah.
Okay, so just to come back to India, so you said that 98% of India's cargo is really going on foreign shipping lines. So when you say cargo, you mean the kind that would go into a container unit, right? Or what we call TU.
Yes.
Do you have a sense on what the overall composition of India's cargo is that's outbound or inbound?
I think overall container would be a big chunk. About I think 25-30% would be containers. Others would be, your dry bulk or, your even POL, which is your petroleum products and other things.
Right. So, how could this be solved? This problem could be solved by India owning more containers or leasing more container space, or how are you seeing that?
Two things that have created a problem, specifically if you look at India. First is, like you said, owning more vessels. Foreign shipping lines have more vessels. They have control over freight rates and the time or scheduling of these ships, which for India increases the cost as well as the time taken for transporting merchandise exports. Also, adding to that, what happens is that almost 25% of India's cargo is transshipped from either Colombo or Singapore, which increases the transit time as well as the freight cost for us. So, if we own more vessels and if we have now, some ports, transshipment ports coming up in India, I think that will definitely reduce the time taken, reduce the freight cost, and we'll also be able to manage the schedules better.
Right. But the reason there is such a high proportion of transshipment is because smaller ships from India, reflecting also the amount of cargo we are carrying or can carry, need to go to bigger ships that are docking at some of these ports like Colombo. Is that right?
Yes, exactly.
Right. So just to come back, so you're saying that for that 98% of India's cargo that can go in the form of merchandise trade, but this, I am assuming you mean both imports and exports. Is that right?
Yes.
Right. So for that size of, let's say, market that there is, what is the sort of realistic possibility of investments coming in and what would it take? And equally, I'm saying, why wouldn't it have come already?
I think the thought process was not there. But if you look at the Adani ports that is coming up in the south, which is a large transshipment, then we have a port that is being planned in Andaman Nicobar also, right? So there is now the government thought process that we also as India can have transshipment ports. This is now starting to materialize. We will see this change happening. That large ship would start coming up to India.
And I mean, and not to take you into a ports discussion. So let me come back. So if, for example, let's say we were to see an easing off in the Middle Eastern tensions, which means hypothetically ships start going through the Suez Canal again, would that change the economics once again?
We feel that would change the economics drastically. Because, like I said earlier, before the Red Sea crisis, we had the kind of an overcapacity in terms of containers. And the charter rates were falling down. And it had, I think, bottomed out somewhere in November or December 23. And then post this Red Sea crisis have sharply gone up. So if this Suez Canal opens up again, we will again have that, overcapacity and prices should start coming down.
So you're saying that, okay, the economic growth argument is well taken. And you're also saying that regardless of whether where the container markets open up, prices crash or not, it does make sense for India to invest in, let's say, more ships and more container carrying ships as a long-term strategy.
To add to that, what also needs to be done is that if you currently see, right, on the west coast, we have two ports, Mundra and Nhava Sheva, and we are facing severe blockages and congestions in these ports because of either, equipment shortages or inefficiencies in berthing space, delay in custom clearance, documentation. So all these things also have to be cleared. So the port authority, ports and the government will have to work together to make that system more efficient, which will help, bring down that logistics cost.
Aniket, thank you so much for joining me.
Yeah, thanks. Thank you, sir.
The China conundrum. India's economic dependence on China is, of course, worrying and has been. So much so that even as the Indian government is bracing to handle dumping of Chinese goods because other countries like the United States are stepping up duties or rather stepped up duties on a range of products from solar panels to steel starting last week, the Indian government's own firms are pointing out that they are dependent on China. NTPC Green Energy, the renewable energy arm of state-owned energy major NTPC or National Thermal Power Corporation once has said in an initial public offer or IPO filing that the government restrictions on trade ties with China will adversely impact its business given that China is a leader in solar and wind equipment manufacturing. Last year, NTPC Green Energy imported about 1,200 crores worth of solar and wind equipment from Chinese suppliers, the Business Standard reported, adding that NTPC Green Energy also purchased equipment worth about 5,500 crores from Indian suppliers. So if import duties rise, as they very well could, then the cost for NTPC will obviously increase. Some 60% of the smartphone market, by the way, is also controlled by Chinese firms, and imports from China, including in steel, have been rising despite all efforts otherwise. That was the Core Report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the Core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in, and thank you once again for listening.